Thursday, May 19th, 2016. I'd like to talk this morning about the Federal Reserve and the FOMC minutes that came out yesterday at 2 p.m. New York time, 7 p.m. London time. Initially, the stock market reacted quite negatively. The Dow went down like 100 points, mainly because the markets and analysts and the mainstream financial media interpreted the minutes as meaning that the Fed will maybe hike in June, that the rate hike in June is now, on. But it's still very conditional. The Fed still said that they need to see the economic data, if labor market data, inflationary pressures rise and the economy improves, they will maybe hike by 25 basis points in their next meeting, which takes a couple of days. It's 14th and 15th of June, so the decision will be on the 15th of June. Back in December, when the Fed hiked for the first time in 8-9 years, I'm not sure exactly now how many years it was, they hiked by 25 basis points on December, I think it was December 15th or 16th. And all the talk then was, oh, the Fed's going to hike 4 more times in 2016. And here we are, almost in June already, and they haven't hiked again. And the economy is slowing down. The minutes were for the meeting that took place on April 26th and 27th, where they did nothing again. And if you look at the data from the 28th of April, which is the day after the meeting onwards, we have like the preliminary GDP, which came out the day after. It was expected 0.7 year on year for the first quarter, and it came out at 0.5. We had the jobless claims that came out on the same day, the initial weekly jobless claims. That was expected 260, came out 257, but it did go up from 248 the previous week. And most importantly, if you look at the core PCE index, which the Fed actually says on its website that it's the main inflation measure that they look at, even though they do look at other measures, that core PCE on the 29th of April came out at 1.6%, and it dropped from 1.7 in February. 1.6% was the March number. And the Fed, they want that number at 2%. So actually, it was nowhere near 2%. And then, later on, the beginning of this month, we had the jobs data, and the Wednesday before the jobs data, we had the ADP non-farm employment data, which is like a precursor to the non-farm payroll. And that ADP was expected to be 196,000. And it was actually 156,000, so a lot lower than expected. And it dropped from 194,000. And then, we had the non-farm number, which came out on the 6th of May. And that came out at 160,000. It was expected around 205,000, and it dropped from 208,000. So if anything, the numbers are not really great. Recently, we had some good retail sale numbers, but all in all, the numbers are getting worse. Jobless claims have increased quite substantially, and it will be important to look at it today. We've got jobless claims today because it's Thursday and it comes out every Thursday, 8:30 New York time. But jobless claims has risen from the 250,000 range, and on the 5th of May, it came out at 274. It was expected 260. What else? I think the latest last week, jobless claims came out at I think 294, and it was expected 274. So it's going to be important, of course, to look at the numbers coming up today, the non-farm in the beginning of June. And I don't think personally, maybe the Fed might hike by 25 basis points, but that will be it for this year, because with the elections coming up soon, I don't think they'll hike that close to the elections anymore. So this is their last chance to hike before the general elections in the U.S. In terms of the markets, the Dow and the S&P actually rebounded and finished pretty much unchanged despite the hawkish comments by the Fed. And I find it funny that they call the Fed hawkish, because if you actually read the minutes, which I've got in front of me, which is 13 pages, on the last page, one of the paragraphs says, and I quote, "The committee is maintaining its existing policy of reinvesting principal payments from its holding of agency debt and agency mortgage-backed securities and of rolling maturing treasury securities at auction, and it anticipates doing so until normalization of the level of the federal funds rate is well underway. This policy, by keeping the committee's holdings of longer-term securities at sizable levels, should help maintain accommodative financial conditions." So, yeah, that's how hawkish the Fed is. Rates are between, Fed funds target is between 1/4 to 0.5%. Unemployment is 5%, according to them. The economy is doing well. The Dow is near all-time highs. So why are rates at near 0%? Well, basically it's to keep the financial system and the big banks from going under. This is not about helping the main U.S. economy. And yeah, the economy is in the doldrums. That 5%, unemployment rate, everyone knows it's a farce. There's almost 100 million Americans that could work that are not working. 47 million Americans on food stamps. So the Fed reminds me of, or Janet Yellen reminds me of Comical Ali, who was the Iraqi military official during the 2003 Iraq War when the Americans invaded Baghdad. And he was on camera, I think, with CNN and saying, "Oh, the Americans are nowhere near Baghdad. We're going to stop them." And behind him were American tanks. It's like Janet Yellen. "Oh, yeah, we're going to raise interest rates. The economy are doing great," and and you got all these, all this evidence that the economy isn't doing well. So Comical Janet or Comical FOMC is still out there. So another thing related to the markets, gold was around 1273 before the FOMC minutes, and it closes at 1:30 p.m. New York time, and then it reopens on the access system, which is a lot less liquid on COMEX. So gold closed around 1270, so 72 area. It was down a little bit on the day, but once this FOMC minutes came out, it dropped to like $20. So did silver, drop way below $17 to like $1680. And yeah, despite that, the stock market rallied, but gold stayed down. I would say, when the Fed hiked rates in December 16th, the next day, gold touched 1047, and December 5th it touched 1045, and ever since then gold has been going up. So I personally think this is just noise, in the market, and gold is still, in my opinion, the place to be. Ask George Soros, Stanley Druckenmiller, who used to work for him. All these big investors are going into gold. There was a big correction in the mining shares, but I guess all these markets have been going up quite you know, strongly, the mining shares especially. So a correction is probably a good thing. What else? Yeah, that's about it. I don't think, you know, you could call the Fed hawkish. They they're just trying to like keep their fingers in the hole in the on the dike, you know, like the little Dutch boy, you know, trying to stop the things from getting out of control. And one day they will. So yeah, I think it's all propaganda. You know, the market has to dissect every little word from the minute to decide whether it should go up and down, and that's done by the, you know, the machines, the computers, the algorithmic, you know, equations and formulas of trading systems. So it's quite strange. This morning, though, so we're almost 11 o'clock London time, which is still 6 a.m. New York. The futures do trade, you know, almost 24 hours. So the Dow is down 83. So yeah, even though the Dow rebounded yesterday, it's down today. S&P down 10. Gold still under pressure. We went down to 1252. We're now 1255. So yeah, and silver 1668. So yeah, to conclude, I think, you know, the FOMC and, you know, and Janet Yellen, they're like comical alley. Ignore the noise of the markets and, you know, bet against the central bankers. Just like Greg Manorino says, bet against the central bankers. Be your own central bank and look after yourself and your family and do whatever it takes. And don't buy into the Fed propaganda. Take care. If you like this video, by the way, subscribe to my channel if you haven't done so. Give me a thumbs up and share it with friends. I'll talk to you later. Bye.